Global commodity markets are facing significant pressure this weekend as geopolitical developments in the Middle East collide with mounting signals of physical metal supply tightness across major Western vaults. Analysts and market observers are closely watching a convergence of data points across silver, gold, and crude oil markets ahead of tonight's CME Open. Starting with silver, Western spot prices are currently sitting at $84 per ounce. However, Shanghai is pricing physical silver at $96, a $12 gap between what the paper futures market reflects and what buyers in the East are actively paying for real deliverable metal. That divergence is drawing attention from market participants tracking physical versus paper pricing dynamics. At the same time, COMEX total silver inventory registered 349 million ounces as of Thursday, representing a decline of 2.2 million ounces in a single trading session. That marks 9 consecutive weeks of net inventory declines. The weekly drain totaled 8.4 million ounces, the equivalent of approximately 262 metric tons removed in 1 week alone. Simultaneously, London Bullion Market Association silver inventory fell 2.4% in February, now sitting at 870 million ounces. Both major Western vaults are losing metal at the same time. On the energy front, U.S. and Israeli forces have struck major oil infrastructure inside Iran over the weekend. Oil has spilled from depots into drainage systems and caught fire, with walls of flame reported on Tehran's highways. Residents woke Sunday to black smoke and acid rain clouds over the city skyline. Iraq's oil production has collapsed by roughly 60% as the ongoing conflict disrupts tanker movement through critical shipping lanes. On decentralized futures platform Hyperliquid, which continues trading while CME remains closed on weekends, U.S. crude oil is currently priced at $115 per barrel after reaching a session high of $126. Brent crude on the same platform is trading at $97 per barrel, reflecting a 5 to 6% gain after earlier touching 10% higher. Turning now to a deeper look at the energy situation and its broader regional implications. The strike on Iranian oil infrastructure represents a significant escalation in the ongoing conflict. Beyond the fires burning in Tehran, reports indicate that the United States and Israel are planning to deploy special forces into Iran with the objective of seizing its nuclear stockpile, approximately 450 kilograms of highly enriched uranium, a quantity described as sufficient material for approximately 10 nuclear weapons. If that operation proceeds, a ground incursion into Iranian territory would move from contingency planning to a stated operational objective, fundamentally altering the duration and scope of the conflict. The Strait of Hormuz remains the central pressure point for global energy markets. Approximately 20% of global oil flows through that single passage. Adding to regional instability, Iran struck a desalination plant in Bahrain over the weekend. That detail carries significant weight beyond the immediate headline. Kuwait sources 90% of its water supply from desalination infrastructure. Qatar is near 100% dependent. The United Arab Emirates and Saudi Arabia both draw above 70% of their water from the same type of facilities. When desalination infrastructure becomes a battlefield target, the escalation calculus for the entire Gulf region changes considerably. Iran's foreign minister warned that attacking infrastructure carries grave consequences, and then demonstrated that warning by striking Bahrain's water supply. The conflict has therefore moved beyond missiles and military installations. It now encompasses energy systems, water systems, and shipping lanes simultaneously, all along the same Gulf coastline that faces Iran directly across the Persian Gulf. When those three categories of infrastructure become simultaneous targets, oil markets shift from pricing supply and demand fundamentals to pricing geopolitical systemic risk. Saudi Aramco recorded its largest single-day stock surge since April of 2023 on Sunday. Aramco fields came under drone attack over the weekend, with minor reported damage at the Abqaiq site. The Ras Tanura refinery, Saudi Arabia's largest, was forced to halt operations following last week's strike. The company is now rerouting shipments through Red Sea facilities on Saudi Arabia's west coast to bypass the Strait of Hormuz entirely, with 8 supertankers already loaded this month, placing the company on pace for a record volume of alternative routing. Aramco also raised its April oil price for Asian buyers by the largest margin since August of 2022. The company's earnings report is scheduled for release on March 10th. South Korea is now weighing an oil price cap for the first time since 1997. The last time energy markets reflected conditions of this nature, the period was widely compared to the supply shocks of the 1970s, a decade characterized by inflation that monetary policy struggled to contain and significant pressure on dollar credibility. Staying with the broader strategic picture, higher oil prices place particular strain on manufacturing-dependent economies, particularly those that are net energy importers. Higher import costs reduce trade surpluses, compress export competitiveness, and because oil is priced in US dollars, every importing nation must first acquire dollars to purchase energy. President Trump stated publicly that the war will continue for a little while, declined to project a timeline, and when pressed, responded with the phrase, "whatever it takes." In the first week of the conflict alone, the United States has spent approximately $6 billion, $4 billion of which went toward munitions, primarily missile interceptors. On the geopolitical leadership front, Iran has selected a new supreme leader, and an announcement of the name is expected soon. Israel immediately stated it will target every new leader Iran appoints. Iran, in turn, declared it is prepared for full-scale war. These are not statements indicative of de-escalation. They reflect entrenchment on both sides of the conflict. China has formally entered the diplomatic frame. Foreign Minister Wang Yi, speaking at the National People's Congress session, stated that China stands ready to restore order, tranquility, and peace to the Middle East. That language represents Beijing signaling strategic interest in the region's future architecture at the precise moment that existing regional architecture is under maximum stress. Iran is a key node in China's Belt and Road infrastructure, and Middle Eastern oil flows primarily eastward. China's positioning in this moment is being read as calculated and deliberate. Turning to broader financial markets, the risk asset environment has deteriorated sharply. Over $190 billion was wiped from the cryptocurrency market over 3 days. Bitcoin declined more than 8%, and Ethereum fell nearly 10%, and that is on top of losses already recorded on Friday. U.S. equity markets also closed lower across the board. The S&P 500, NASDAQ, Dow Jones Industrial Average, and Germany's DAX all finished Friday's session in negative territory. $900 billion was erased from U.S. equities in a single session, with risk assets broadly pricing in the prospect of a prolonged conflict. In the private credit space, 3 of the largest alternative asset managers are reporting simultaneous liquidity stress. BlackRock has limited withdrawals from its $26 billion HPS corporate lending fund after receiving $1.2 billion in withdrawal requests within a single quarter. The firm capped redemptions at 5% and blocked the remainder. Blackstone's $82 billion fund hit record withdrawal requests during the same period and was required to inject $400 million of its own capital to cover investor exits. At Blue Owl, investors withdrew 15.4% from one fund in January alone, forcing the firm to sell $1.4 billion in loans to fund those payouts. Blue Owl has since permanently halted traditional redemptions at that fund. 3 of the largest alternative asset managers, in the same window, all encountering the same liquidity wall. On gold, the mainstream framing of recent price action warrants a closer look at the underlying data. The GLD exchange-traded fund recorded one of its largest weekly outflows in recent years. $4.2 billion exited in a single week at near all-time high price levels. Despite that volume of paper selling hitting the tape, gold remained above $5,170. When significant paper selling pressure fails to move price lower, the underlying structure is considered anchored rather than fragile. That divergence between paper outflows and physical price stability is the data point drawing attention. Gold closed Friday at $5,170. The tape reading levels being monitored are $5,181 first, followed by $5,200. Gold was the stronger performer relative to silver on Friday, and that relative strength is being noted. Silver closed Friday at $84.6, rejecting the $85 level 3 times despite the US dollar finishing the session lower. That rejection is considered technically significant. Friday's 8 a.m. lows remain the invalidation level for both metals heading into tonight's open. The data calendar for the coming week is also notably loaded. The Consumer Price Index report is due Wednesday. Gross domestic product figures, the Personal Consumption Expenditures Index, and the JOLTS employment data are all scheduled for Friday. Any one of those prints landing outside expectations hands paper sellers a potential window. The intersection of inflation data releasing into an active oil supply shock is being described as a particularly significant read for markets this week. As markets prepare for tonight's CME Open at 6 p.m. Eastern Time, the full picture emerging across commodities, equities, private credit, and geopolitics presents a complex and multi-layered set of conditions for market participants to navigate. On silver, 9 consecutive weeks of COMEX vault drainage, a 2.4% decline in LBMA inventory through February, and a $12 gap between Western paper pricing and Shanghai physical pricing represent 3 simultaneous signals moving in the same direction. On gold, despite $4.2 billion in GLD outflows in a single week at near record prices, spot gold remains above $5,170, a divergence between paper selling and physical price stability that is being closely monitored. On crude oil, Hyperliquid's decentralized weekend futures market is pricing U.S. oil at $115 per barrel and Brent at $97, while mainstream media headlines continue to carry a de-escalation narrative. Energy markets, by contrast, are pricing supply risk. The Strait of Hormuz, drone attacks on Saudi Aramco infrastructure, the halting of operations at the Ras Tanura refinery, Iran's strike on Bahrain's desalination facilities, and a stated U.S.-Israeli objective of a potential ground operation into Iran to seize nuclear materials. These are the developments now embedded in market pricing. The regional conflict has expanded beyond military targets into energy infrastructure and water supply systems, fundamentally altering how markets are assessing geopolitical risk duration. Simultaneously, three major alternative asset managers, BlackRock, Blackstone, and Blue Owl, encountered liquidity stress in the same period, with withdrawal requests exceeding redemption capacity and funds moving to cap or permanently halt traditional redemptions. Private credit liquidity conditions are tightening at the same moment that equity markets, cryptocurrency markets, and energy markets are all repricing risk. Iran's preparation for a new supreme leader, Israel's stated intention to target any successor, Iran's declaration of readiness for full-scale war, and China's formal announcement of readiness to restore peace to the Middle East. These are the geopolitical coordinates surrounding tonight's Open. President Trump's public statement that the conflict will continue and that the United States will do whatever it takes remains the defining policy signal on duration. Key data to monitor through the week includes daily COMEX inventory reports, publicly available and updated each session, monthly LBMA statistics, and the sequence of major economic data releases culminating on Friday. CPI on Wednesday will be the first significant domestic data print to land into an active oil supply disruption. The question being framed for tonight's Open is straightforward. With hyperliquid crude at $115 and black smoke over Tehran, weekend metals pricing on PAX-G and Kinesis silver is sitting essentially flat from Friday's close. What that divergence means, whether metals have not yet processed the weekend's developments or whether something else is at work, is among the central questions heading into the session. This has been a full market briefing ahead of tonight's Open. All figures referenced, including COMEX reports, LBMA statistics, and the BlackRock filing, are publicly available through primary sources including Reuters, dated March 6th. This broadcast is for informational purposes only and does not constitute investment advice.